Indian trends. So the most important, event which happened recently was the RBI MPC policy on 6th of June, where the RBI voted 5:1 to change the policy rate by 50 basis points to 5.5 against consensus expectations of 25 basis points. Not only did RBI cut the policy rates by 50 basis points against the consensus, they also changed the stance uh, to neutral from accommodative in just one policy. To recap, RBI had been in a withdrawal of accommodation mode since 2022, and they had been maintaining the policy stance of withdrawal of accommodation, uh, you know, till they moved to accommodative policy stance in till April. And in just one policy, RBI has changed the stance back to neutral, which is quite unprecedented because usually when central banks go for a policy stance, at least we have not seen central bank changing the policy stance in just one policy. Uh, just to give a perspective, the RBI had defined the accommodative stance that either they will hold the policy rate stable or they will go for a rate cut. What a stance, in terms of neutral means for RBI is that they can go for a rate cut, they can hold the rates, they can even hike the rates. Uh, so while the stance change may seem to be quite strong, uh, we believe the reason for stance change was having cut policy rates by 50 basis points and keeping them bringing them all the way to 5.5, and especially when the market was expecting only 25 basis points. If the RBI had not changed the stance to neutral, and if they had continued with the 50 basis cut, market would have expected more rate action in the August policy as well, and it could have led to meaningful volatility in market reaction if RBI would have not continued the rate cut cycle in August policy as well. Since RBI was quite clear, as confirmed by governor in the press conference as well, that most of the policy easing has already happened and they are not seeing any major rate cuts from here on. The RBI wanted to also kind of give this messaging to the market by changing the stance to neutral, that the most of the policy action has been front loaded. Since typically central bank actions take 2-3 quarters to take really have an impact on the real economy, what RBI wanted to do by this policy was to, instead of doing two rate cuts in June and August of 25 basis points and having their effect play out much ahead, after August, they wanted to see the whole benefit to the economy probably much faster. And not only they changed the stance to neutral, they also cut CRR by 100 basis points to 3%. Mind you, the last time the CRR was taken to 3% was during the pandemic. So, so this is a very, very strong signal given by the central bank to the banking system that the liquidity will be kept uh, positive to ensure faster transmission of the existing rate cuts. And this CRR cut has come at a time when the system liquidity, which the interbank liquidity and government cash balance, if you take that into account, is already at 6 lakh crores. So to do a CRR cut, which will release about 2.5 lakh crores into the banking system, when the system is already sitting at a 6 lakh crores liquidity, gives a very strong messaging to the banks that there will be abundant liquidity at all points of time so that they can plan their deposit raising activity accordingly. They don't need to aggressively raise deposit rates. So when they are not raising their deposit rates, when they're not chasing deposits, they can in fact reduce their lending cost, which should probably kickstart consumption and some investments down the line. If you look at the CPI inflation assessment, as we can see, from 4%, they have now moved to 3.7%. in the current policy. Most of the reduction has come in the first quarter for FY26 and the second quarter from 3.6% in April 25. Now the inflation estimate for first quarter of FY26 has been reduced to 2.9. If you look at the second quarter, the 3.9 has been reduced to 3.4, and the last two quarters has been broadly kept unchanged. If you look at overall growth assessment, the growth assessment has been kept unchanged at 6.5%. So it's the reduction in inflation from 4% to 3.7%, which gave RBI greater confidence to cut by 50 basis points, and at the same time also give liquidity. Uh, Interestingly, RBI has affected the CRR cut from September onwards. So the CRR cut is not really affected from today, but by September. One of the possible reasons for doing CRR cut in September is that RBI has about $15 billion of negative net FX forwards which are maturing in next 3 months. So as RBI gives the delivery of dollars to the system, it may lead to about outflow of about 2 lakh crores on static basis. So that gets kind of set off with the CRR cuts which RBI has given. The second part which RBI also brought in the current policy, that so far RBI has been working on potential growth. So potential growth is a growth rate of an economy in which the economy is neither hot or cold. That means neither the inflation is going above central bank's target band, neither inflation can go below central bank's target band. So what RBI has brought in this time is the aspirational growth. So the potential growth as estimated by many economists for India in recent times has been around 6.5%, which is already RBI's projection, which we already achieved in FY25. So by bringing in an aspect of aspirational growth of 7%, what that means is that growth is at the forefront of RBI's monetary policy, at least till the time inflation is close to 4.5%. So we think RBI will continue to provide liquidity. RBI will continue to ease regulatory burden on the banking system to ensure that there is sufficient credit growth to take the real GDP growth close to the aspirational level of 7% rather than just the potential level. So that's, I think, the key takeaways one should take from the RBI monetary policy.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.